that's very interesting about private equity as an asset class is if you compare it to similar styles where limited partners invest into one style over another, over the past 10 years, it's returned about 12.5% to its limited partner investors, which is a premium to credit funds or real estate or even venture capital over that period. So they're definitely integral to M&A markets. They're long-term partners for business owners, and there's an intense proliferation of capital where there's a lot of creativity in what can be accomplished if you're looking for new capital and investment partners. The next part of the presentation is we wanted to define the relevant universe of what is private equity for the purposes of this discussion. And this is important because if you talk to 5 people, you'll get 10 definitions of what private equity is. So in the middle market, I would define private equity in the first 2 columns as being middle market buyout, which is a fund that's focused on control investments. They usually look for a platform and then engage in bolt-on acquisition growth, and they take an active role from a governance and management perspective. Also, when we talk to Aubrey later in our presentation, Tower Arch, for example, they don't officially call themselves this, but they're a partnership firm. They like a management team. They like to go to a business owner, maybe take a few chips off the table, engage in an equity recapitalization on a flexible cap structure, and then invest and grow the business into its next phase of growth. Quite often, when you're looking at transactions in the Intermountain West or Rocky Mountain region, an important part of the market is what we call a fundless sponsor or regional investor, which is usually a private individual that is very actively looking at transactions, and they're looking at a macro outlook on the region. And once they gain comfort with the story, they can be a great long-term partner. And then the last bucket on the right is family office, which has grown in prominence over the past 10, 15 years. And that's basically when a family that has a substantial amount of high net worth wealth engages in investing themselves in real estate. They may take LP stakes in private equity funds, but they also engage in direct investing on their own. And what we tried to do on the bottom of slide 6, I won't take you through it, is just the idea that if you look at those 4 buckets of investors, they all vary in their demands for control, like a majority transaction. They vary in their demands for control over management and the board through the life cycle of investment. Some of them vary in how much debt they may use to drive returns, and some may act as long-term partners in terms of putting on a cap structure that has flexibility for the future. And also some may have a strict 5 to 7 year hold period. Others may say, hey, let's hold this for 10, 15 years, and who knows what will happen. And quite often, the more you go into an illiquid long-term partnership, typically the exit will be back to your partner, and so there may be a defined exit at the end of the lifetime of the investment. So then the next question is, how do private equity firms make returns through the life cycle of investment? And this is important because if you're a business owner and you're looking to eventually raise capital or sell, it's important to always look at how they make money and will view you as an investment and what that means for your positioning story and approach to valuation. And typically in the private equity world, they define returns in 2 ways. One is a multiple of money, where the equity that they put into a transaction over a 5 to 7 year period, they look to double or triple it. So 2 to 3 times multiple of money. And then the traditional metric is internal rate of return, which is the annual equity growth rate over a 5 to 7 year period, which is typically 25% plus in the mid-market. And so when you look at that on this chart is just an illustrative diagram, but it really shows that on the right side, you see a curve depicting the aggregate returns over the life cycle. And then on the left side, the blue bars really tells you where does money go in and where does money go out as you basically buy the company and then sell it 5 to 7 years later. And so it's important to understand the levers of value. So when you invest in the company, how much leverage do you put in? Are you looking at this as a kind of buy and build platform where you look at a blended acquisition multiple? So you'll pay up for the first investment, and then you become a quasi-strategic because you have synergies, and then you can engage in bolt-on M&A and lower the blended multiple over the life cycle, so the in multiple. And then you may go in and look and say, okay, Where do I take costs out? How do I professionalize the management? Are there elements of IT that I have to put in? Can I bring in other portfolio companies from my portfolio to put in synergies to the business? And are there sales and marketing initiatives to grow into new areas, or initiatives to improve our facility footprint that may grow the business over time? The next piece is, as I mentioned earlier, bolt-on M&A. So how do I transform the business and grow by buying other companies, typically smaller and at more attractive multiples? And then I begin to integrate them into a larger platform. And then towards the end of the life cycle, quite often some firms, not all, will then take money out of the business and do a recapitalization, and that's called a dividend recap, and then the sale. And you know, on the right side of page 7, you look at what the value levers are, and you have the transaction structure, as I mentioned prior, corporate development through the life cycle investment, and financial engineering is the idea that potentially as you grow the business, the larger it gets, the greater a multiple it will get, and that's called re-rating. Mode of exit, so the big trend right now is SPACs. And because there are special purpose acquisition companies in the market buying assets, there may be a very advantageous multiple. And then what's your capital structure through the life cycle of investment? And that can take on many issues in terms of what's your comfort in terms of risks for the company, and do you need flexibility to accommodate growth initiatives? Moving on to page 8, really the next thing that we wanted to discuss is what is driving this level of activity, because not only is the M&A market more broadly extremely hot right now, there's just a lot of private equity chasing around the same deal flow, and that's very good if you're a business owner, probably very bad if you're Aubrey and Chris on the line. And so on the top left basically shows you the amount of money that private equity firms on an aggregate basis have been able to raise per year over the past couple of years. And the average over the past 4 years is about $250 billion, which is substantially higher than the average from 2010 to 16 of about $120 billion. So there's lots of money that's being raised. On the bottom left is the key thing, and what's called dry powder, and the idea that the aggregate amount of capital that's available for deployment is about 1.3 trillion. It's a record level. And basically this creates an environment where a lot of money is chasing around the same number of deals. On the right side, on the top right, is more Matt Dent and KeyBank's purview, and the idea that you have a very stable and consistent credit market that supports transactions. And you see, even through the COVID crisis that we're just hopefully at the tail end of, there's been a very stable access to debt capital in support of transactions. And on the bottom right really speaks to the idea that there are new forms of alternative capital in the market that are supporting transactions both from a debt and an equity perspective. And so the blue line on the bottom right is what's called private debt fundraising, and the idea that post the financial crisis, there's been a lot of development in the junior debt space where debt funds have been raising money in support of transactions. And that kind of allows sponsors or private equity people to take on more debt and drive their returns and potentially pay more for your business. And the idea of SPAC issuance that's absolutely exploded over the past 12 to 18 months really gives not only new competition for assets as they're being acquired in the market, but also for private equity to find new venues of exit at probably an advantageous multiple. Moving on is really an idea of what are the recent trends that are going on in the space and what are the implications for people looking to sell their business. And so we've identified the 4 trends that are all very strong for business owners and probably not so good for private equity firms, is the idea that there is a growth in what we call buy and build platforms. Secondly, there are new options in secondary sales, and we'll get to that in a second, and exits via SPAC, as we discussed. And there's probably new competition in the market as new assets come out from SPAC capital. And the last thing is there is a explosive growth in the availability of fund styles. So as LPs, who are traditionally pension funds, put money into private equity, there are more options. And because of that, if you're a business owner, you're looking to sell, there's probably more people that you can transact with. So I'll go through each of them very quickly. The buy and build front is the idea that 20 plus years ago, there wasn't a lot of competition amongst PE players. And so, you were able to, buy a company with someone else's money and drive your returns by growing the business organically or engaging in a couple bolt-ons and selling it as an IPO. Because there's so much capital in the market, a lot of large cap players are now looking in the mid market, and mid market is going into the lower middle market. And the idea is that you create a consolidation thesis in an attractive sector, and you back a management team, and you basically build a company by engaging in M&A. And you can see that on the left column that the PE add-ons in 2020 were over 70%. And that's the idea that, there's just more and more buy and build. And so there's more add-on deals going on in the market. As a business owner, that's fantastic, because it means not only are your companies and assets more in demand, but there's more competition. And so the valuations may be more advantageous for you, but not for the PE guys. In terms of secondary and SPAC exits, the idea here is that 10 years ago or 15 years ago, private equity firms would rarely sell to other private equity firms. Maybe a lower middle market would sell an asset to the middle market to large cap, but typically you wouldn't sell to someone else because you're like, okay, you've improved the business and made it better. What am I going to do? But that's kind of changed just because there's so much capital in the system. And you see in that chart where it says secondary buyout, that's the idea of a private equity firm selling to another private equity firm. And that's been stable at about 30% of transactions over the past couple of years. What's very interesting is the idea that it used to be that private equity would eventually either IPO or sell to a strategic or a corporation. And corporates in 2020 are now 36% of exits, where 5 years ago or 6 years ago, it used to be 60%. And that has basically been taken out by the advent of special purpose acquisition companies and the idea that shell companies are going public, or blank check companies, and buying new assets, which bleeds into the third idea of new competition from SPACs. And you see the growth in the number of IPOs in the past year has just been explosive. And really, the implication on the market is that more and more there will be more PE firms not only competing with each other, but also with SPACs for assets. And the last thing is the idea that fundraising has become more refined over the past 10, 15 years, and it's harder and harder for a new fund to get money, to raise money for its own, GP from LPs. And the idea is that a lot of the large cap guys are growing as fund families, and they're able to create new themes or flavors or special situations funds that may tailor and provide new options to business owners. Business owners may have the opportunity to invest with a minority fund. They may be able to invest with what's called a long-term duration fund, which is someone that engages in a 10 to 15 year hold on a minority basis. Or there may be thematic sector funds. So I'm looking at the clock here, and I'm a bit behind time. Apologies. What we wanted to highlight is, if you are a business owner and you're looking to transact in the next 12 to 18 months, the view here is that you should be thinking about, what if I'm going to engage in a conversation or dialogue with a private equity player, what should I be thinking about? And the first thing is, what is the strategic positioning? What are the attributes that PE is looking for? Is it recurring cash flow? Is it an investment thesis centered around consolidation? Is it the idea that there's a secular macro story, or there's potential low-hanging fruit in terms of growth initiatives? And really, that's important, because if you understand how they're looking at a business and how they want to look at you, you can take the time now to engage in structuring, start tracking key performance indicators, and maybe formalize your relationships. Do I want to engage? If they want a management team, do I put out long-term employment contracts? If they would like recurring contracted revenues, do I go to my key customers and try to lock them up for longer periods? Transaction structure is very important when you think about private equity. Some of them like a lot of debt. Some of them are interested in growth capital. So what is the transaction structure that's required in terms of debt, ongoing liquidity, additional equity that can be put into the business that will really address future capital needs? And how does that fit in within the cash flow variance through the cycle of a company? And really, this is important because you really have to blend the structure with management's view on risk and outlook for the company, and really how does that fit with the overall investment thesis. One thing that we talk about with business owners that's quite often missing in the initial discussions is, what is your capital need? How do you define that? And the thing is, especially when you deal with what I call partnership firms, not only are they interested in maybe if there's 3 owners taking 1 or 2 of them out, but they're interested in, how do I put more money into the business to get my 2 to 3 times multiple of money and triple the business over a 5 to 7 year period. So it's very important to think about what is the capital need for growth? What is the timing? What will be the run rate project flows when it starts, returning back to me? The other thing is, a lot of business owners are quite focused on their business for 10, 20 plus years. And because they're internally focused, they may not have had a lot of conversations with acquisition targets. And it's very important. PE guys are going to look at the world and say, how do we grow this business via 1 or 2 or 3 bolt-ons? And it's important for the management team to put on their hat and think about what companies are available, or what relationships do I have in the market, and who could we go out together with this new capital and go out and buy. And really the last thing is, when people engage in discussions with PE, there's always a great macro story that really defines, how am I going to grow? What's the growth opportunity? And a PE buyer will give you credit if you started those initiatives, but it's important, if it's something that's low-hanging fruit, you're only going to get credit for it when you've really kicked it off and are beginning to execute on it. The last 2 things is really the idea that a shareholder or an owner is going to have to think about, what's my role post-transaction? Do I want to be part of the business? Do I want my company to continue on as a corporate legacy, because maybe that may have a hit on valuation? And then really, a PE partner quite often wants a management team. And so it's important now to identify gaps in management and resource gaps and really address that. And the last thing is the idea that in the current market environment, we've always been telling folks that it's less important to look at the EBITDA multiple and more important to look at what the EBITDA is, because people are very focused on, what is the bump, either positive or negative, from COVID? What's the outlook for the new normal? And what's the implication on valuation and the sustainability of cash flows? And it's just very important to think about all these issues as you prep up for eventually engaging with private equity. So just to end it off, and I'll turn it over to Garrett, and we'll start on the Q&A panel. It's really important when you think about private equity, they are amazing partners. There's lots of capital. It's a great environment to transact with them, because there may be strong capital to support your growth and a great valuation environment in which to transact. It's really important to understand, what are my objectives as a shareholder, and how do I find a partner with alignment? It's important to really identify, what do I need money for on a growth basis, and what's my investment thesis, and how do I start now to prepare for a transaction and eventual engagement with partners. And then after that, it's really, what is my targeted outcome, what will be my role post-transaction, and what are the expectations that myself and my partner will have for valuation and structure. So what I'll do there is, we very much appreciate your time and the opportunity to really go through issues that are facing the financial sponsor world. And what I'd like to do is, I'll turn it over to my partner, Garrett, and we'll have a lot of, hopefully, very, very strong Q&A across our panel. And we just appreciate your time.
Thank you, James, and thanks everyone for attending today. We have a very nice mix of panelists today, 2 folks from the investment side, as well as 2 other advisory, including on the lending side and the accounting side. First of all, let me introduce Matt Dent from KeyBank. Matt is the Senior Vice President and Relationship Manager here in Salt Lake City, and really focused on mid-market mergers and acquisitions, as well as structured finance. And welcome, Matt. We also have Matt Bartholomew, who is with BDO USA.
Garrett, you're muted. Hey, Garrett, you're muted.
Oh. Okay, sorry, I was muted. Matt, is there any of those introductions?
I think after my introduction, it cut off. So
Somebody muted me. I apologize. Very quickly, Matt Bartholomew with BDO is a managing director in the Transaction Advisory Services Group, and Matt focuses on quality of earnings reports as well as due diligence in M&A and in the middle market. Aubrey Burnett with Tower Arch Capital. Tower Arch Capital is a Utah-based private equity firm who focuses on founder-led and owned companies in the mid-market. And then we also have Chris Shelton, who is with Orchard Ventures, and Orchard is a family investment office, again, located here in Utah and focused on providing other resources to family-led and entrepreneurial businesses in the mid-market. Gentlemen, thanks for your time today. Appreciate you here. Maybe to start with, Aubrey, coming out of what was often perceived as a tough 2020 in this market, what was your impression of last year, and how do you see the challenges in the next 12 to 18 months in the deal market, the M&A market, that business owners and someone from the buy side is considering at this point?
Yeah, absolutely. Garrett, James, thanks for having me on today.
Aubrey, I think you are.
You guys hear me all right?
Yeah, we can. But we can't hear you.
we can hear you.
So, look, 2020 was a challenging year for business owners and investors alike. I think it certainly had a lot of ups and downs. We spent a significant amount of the first half of the year working with our portfolio companies to institute, kind of what was the new normal under COVID, best practices around social distancing, helping people navigate, how to best handle everything around COVID and social distancing, and implementing best practices across the portfolio. And it really wasn't until the second half of the year that the M&A environment really turned back on. And I think that was true for us and also across the market. We saw really a lot of the transactions that were in place or kind of coming to market in Q1 and Q2 really get put on hold. A lot of people needed to step back and reassess what was going on in their own backyard, if they will, with their own businesses. And as a result of that, there was a pretty big backlog of companies that had been interested in selling, but maybe didn't have access to the market at that point. And really saw that come to fruition in Q3 and Q4 of 2020 with really record numbers of middle market deals coming to engage with investment bankers and really coming to market. And so as we look towards 2021, a lot of what we anticipate there being actually a pretty significant amount of deal volume coming to market. I think there's there's kind of 6 months to a year of kind of backlog of entrepreneurs that, if you're setting aside macro just from their own personal, whether it's their age they're in, the membership dynamics they have with their own equity group, or their partnership, that they're ready to look to bring on a partner and go to an exit. And we're expecting to see a significant amount of that in 2021, particularly when you combine it with a new administration and Congress with kind of unknown outlook on taxes. I think there's a significant amount of entrepreneurs out there that are saying, hey, look, this might be a good time to pursue an exit and lock in capital gains at current levels. And so, that's a lot of what we're seeing just from a volume environment, but certainly from challenges in the next 12 months. I think COVID continues to be a real focus. I think we're not out of the tunnel yet. I think a lot of people are still making sure that they, stay vigilant and that their businesses continue to perform here as we start to see vaccine rollouts. And certainly, I think, as James alluded to earlier, it's a good time to be a seller, but a tough time to be a buyer with all the liquidity in the market. There's a lot of new funds being raised, and I think there's a continual trend we're seeing in the market of If you think of these special purpose acquisition companies that are really large cap, I mean, they're coming in to buy relatively large companies. And then you have upper middle market PE saying, well, okay, well, maybe we'll move into middle market, and then middle market PE moving into lower middle market. And you see that really across the spectrum. And so, while it may seem to be, less relevant to, if you're a small or medium sized business to say, hey, what's going on with these public market IPOs or SPACs, it all funnels down, and we're seeing that across the market. So I think that between the proliferation of private capital being raised and private debt capital being raised, you'll see a continued strong M&A environment from a valuation perspective, even with COVID kind of still being in the background.
Thanks, Aubrey. That's very helpful, and I think everyone on the panel would echo that. Matt Dent, from the lending side, as you look at providing financing for structured deals and private equity buyouts, what do you see as the activity level that you anticipate in the next 12 to 18 months? What are some of the things that lenders are worried about as they're thinking about the amount and cost of debt for M&A transactions?
Yeah, great question. I think, Aubrey mentioned several of the things that we would mention, which is that a lot of times our interests are aligned with our private equity partners. And so as they think about, are we overpaying for the business? That's a big factor for us too. We want to make sure that even though it's not necessarily our investment, we do have money at risk, and we want to make sure that the partner that we're aligning with isn't buying it at such a high multiple that there's not a lot of additional value that could be created, other than, as was mentioned by James, this idea that you can go on a spree of add-on acquisitions. We actually saw acquisitions, add-on acquisitions accounting for about 70% of the activity last year. And so you saw this just huge rise for that purpose. And so as we're thinking about it, we're seeing, while there's a lot of activity and there's a lot of pent-up demand, we really want to be thoughtful about the EBITDA, about the assets. I never would have thought 12 months ago, as we walked into COVID, that we'd be talking about the COVID bump and how do you underwrite towards that. There's definitely some sectors and industries, hospitality, some consumer products that are still affected and are working through it. But there's a lot of companies, surprisingly so, that have seen a big rise from COVID. And so we try to think about what's a normalized level, or is this the new normal? And so as a lender in the lending community, we're all thinking about, yes, there's actually a lot of capital available. You'll see it across the spectrum of types of lenders. Rates are almost at an all-time low. So there's a lot of capital available, but how do we think about sustainable, normalized EBITDA? Matt's on the panel, and Matt's work is important, right? We're thinking about the quality of earnings report as a real strong indicator for us of, can we substantiate the EBITDA? Can we make sure there's no holes in it? A lot of times, especially in the lower middle market, as Aubrey's referring, quality of financials is not always an audit level, and hopefully it is, but we want to make sure, fundamental underwriting is EBITDA based for most lenders and factors of EBITDA.
That's great, Matt. Appreciate it. And maybe following your reference to the work that Matt Bartholomew does, quality of earnings, maybe Matt, you could just give a brief description of what we're referring to as we talk about that work. And then as you look at the deal activity and the impact of COVID on businesses and the proliferation of private equity and family offices, what are some of from a seller standpoint, what are some of the due diligence items that they should be prepared to really work on as they consider M&A in this environment?
Yeah, absolutely. Thank you, Gary. Appreciate the opportunity to be able to join this team. So from early on, I would say it was probably the first week of April or second week of April, we were already tossing around. Everyone's talking about this EBITDA, right? Where everyone's trying to understand, we take EBITDA, right, and understanding what EBITDA, earnings before interest, tax, depreciation, and amortization. Anyway, so it's really meant to be a proxy for cash flows. Is ultimately what we're trying to understand. And so EBITDA became this big, kind of running, nerdy accounting joke about, okay, well, what's COVID, right? But so that C at the end, what is that COVID impact really to the overall business? And so we did see a number of deals that we were working on when we hit that second week, third week of March, get put on the wayside, put on the table, so to speak, because we just said, hey, well, there's a consumer products company or a restaurant or a particular hotel or resort, something in the hospitality space that needs to be. We got to figure out what's this look like during COVID, post COVID, and how does that get normalized over time. So maybe taking a further step back. As we try to evaluate, usually we're looking at 2 to 3 years of historical financial information and looking at a company. And so from an EBITDA perspective, we're dealing with the operating results or the P&L of the company. Well, what does that tell us from a cash flows perspective? What does the balance sheet teach us about their impact on cash flows? How much are they absorbing or contributing to cash flows? And so as you think about COVID, we hit a point, so a certain amount of companies we're touching on both deteriorated in performance, but also increased performance. I mean, there's a number of companies that weren't going to market that decided to go to market as a result of COVID because they saw their e-commerce or direct-to-consumer business really start taking off in March and really April, May, June really taking off. And so they took the opportunity to be able to take, market share or just brand awareness or otherwise as people were buying from home or otherwise and not going to the store. And so they ended up having successful transactions, a number of them at the end of 2020. So when sellers want to think about the impact of COVID on their business and they look back and say, hey, yeah, I was going to go to market in 2020. I'm in 2021 now, things have normalized out. What we see is what you want to do is really have one investment in your back office with your accounting team to the extent that you feel like your monthly financials is a good close process. So you can look at your monthly financials, because when people look back at February, March, April, May of 2020, they really want to understand the story. So while you might have normalized in July, August, September, subsequent months, it's really being able to have a good accounting process on a monthly basis to be able to have the numbers validate the narrative that Aubrey or Chris on the investment side or Matt on the debt side can be able to hear and understand and be able to see cleanly those numbers and the impact. Because I think a lot of people are willing to understand and give credit for it. It's been my experience, but you have to be able to ensure that the numbers synchronize with the story.
That's great. And so when you perform a quality of earnings study, what specifically are you looking at, and how does that differ from an audit?
Yeah, no, I appreciate the question because get that question a lot. So just to give anyone does understand what we do at BDO. So I'm an ex-recovering auditor myself. So all of us have been with Big Four accounting firms. A lot of us have been auditors in the past. And so usually an audit is something that's stated that's great to have because an audit firm has come in there and looked at all the, dug around, and they have different adjustments that they've applied to the business or to the numbers, I should say. Whereas a quality of earnings, we step in and take your most recent available month. So let's say we're in August of 2021, we'll take July of 2021 and backwards for 2 or 3 years and evaluate that. So while you might have a 2020 audit or 2020 review or 19 review, all those are great in helping us provide credibility and validity to the numbers. But as you've grown, it's hard to be able to really have a third party or feel like you're justifying or putting forth these numbers that are within 2021 when they don't get the benefit of an audit because you haven't closed out the period, you haven't met with them, so it allows anyone like in Aubrey and Chris's position to hire someone like us that can be able to evaluate the most recent available financials that are out there. And so really the 3 pillars of our work really focus on understanding those cash flows through EBITDA and what kind of non-recurring, non-operational accounting nuance type items may affect those numbers. And then we focus on net working capital. So we're looking at those balance sheet items that either contribute or take away from the cash flows of the business through their current assets, current liabilities, because generally speaking, I'd say 99% of all deals include a net working capital mechanism, which basically says, hey, I've got this proceeds number. I'm selling my business based upon 10 million of EBITDA at this multiple. So that's my purchase price number. but then you'll have a mechanism around net working capital that says, hey, this is a regular net working capital level of, you know, my receivables, my payables, what have you. And there's an adjustment there based on where you're coming in at the point of close versus that agreed upon peg, so to speak, of net working capital. I'm happy to talk through anyone through this, but either that's an addition, that either offsets or adds to that purchase price. And then also you have whatever you land at in your cash position as well as your indebtedness position. And so indebtedness is, hey, within the business, do I have a loan with KeyBank? Do I have severance that needs to be paid out due to these individuals? And so those end up being offsets to the purchase price. So those are all kind of components to the overall transaction economics that need to be evaluated, eventually get papered by lawyers. But to really understand it, you have to look at all of the activity from an accounting perspective and come to some type of an agreement between parties on what do all those components look like? How does that affect what we anticipate to be proceeds that go to the seller, and is buyer comfortable with all of those components and everyone understands them? So it gets highly nuanced, and particularly in some industries where there's like a lot of accounting nuance, but allows for us to have an updated view of the world through the most recent available results, and which certainly a seller that usually has a well-performing asset usually is going through a growth pattern, so they want to get paid on that. And then two, it provides credibility and validity on where all those components are landing, such that there can be, you know, good faith negotiations and agreement between both parties that allows the deal to progress and get towards a higher probability of close.
Yeah, it's great. Certainly, as valuations are usually anchored in cash flows and EBITDA, having a third party really be able to go and evaluate that to allow both from the buyer and sell side confidence that they're focused on an accurate number is very big. Well, we've got a couple of questions from folks who are interested in the difference between a family office as an investment firm versus private equity. And Chris, as you guys are relatively new, maybe you can give a brief introduction as to what Orchard Ventures is focusing on, maybe distinguish between what a family office might look for and some of the characteristics of partnering with a family office versus private equity, I think would help answer a couple of these questions.
Sure. Yeah, happy to do that. First off, can you hear me? Wanted to do a sound check. Okay, yeah. Terrific. Yeah. Great. Well, look, I came from a private equity background, and so it's been an interesting transition to kind of step into the family office world. And one thing I would say at the outset is that if you've met one family office or spoken to one family office, you've spoken to one. They're all very different and very unique in their goals and their approach and strategy. And you know, from a high level, there's a lot more flexibility in a family office in what they can invest in, from kind of type of asset or security that they're investing into, or the structure or the duration that they make that investment in. And so there's a lot of flexibility, and specifically to Orchard Ventures, you know, we're very much a generalist from an industry or sector standpoint. We invest across multiple asset classes, venture, growth, buyout. And so really for us, we're focused on making sure that there are the right kind of deal dynamics and partnership characteristics involved with any investment that we do. And generally that's focused on making sure that, you know, we're partnering with the right people, that there's good alignment in the goals that we have for the company, and that we're all incentivized to kind of link arm in arm and march forth in the same direction. We're focused on the market, making sure that we're investing into strong markets with good tailwinds, and you know, always wanting to know that we're positioned well in that market relative to competitors, and that we have entrenched relationships with customers. And of course, you know, good stability on the financial side is helpful. Obviously, that changes from venture all the way down to buyout, the way that we think about that. But you know, at a high level, I would say that the key thing that's different about a family office versus traditional private equity is that, you know, there's a lot of flexibility in how you approach a transaction with a family office. And that can be with regards to how you structure it, the timeline of that investment, the level of involvement from the family office, and kind of the return goals. It may not always be a specific timeline and a specific target return that you're trying to accomplish. And so I think the benefit of it can be, catering an investment in a partnership exactly to what your specific needs are. So I think that's a high level how I would think about a family office versus maybe a traditional private equity investment firm.
Yeah, that's great. I think that's very helpful as people look at these alternatives to really understand some of the defining characteristics about how the various investors look at that. Aubrey, if I'm a seller and I'm thinking about selling in the next 6 to 8 months, what are the things internally that I should start preparing for and thinking about value drivers from your perspective? What are the things that you're looking for within a company that help you pay as much as makes sense from your firm's standpoint?
Yeah, absolutely. So look, we often talk with entrepreneurs at different levels of interest in selling. Some of them are saying, hey, I'm 5 years away. Some of them are saying I'm 6 months away. And where you are in that cycle depends a little bit upon that level of advice. But what I always tell people, first and foremost, a little bit is kind of know thyself, understand a little bit, take a step back and say, where is my business today and where is my team today? One of the things we look for specifically is partnering with a strong management team that wants to retain a big piece of equity ownership. So take a look in the mirror and do some thought and say, what is my realistic timeline to retirement? Or do I, what level of liquidity do I want to take now versus how much equity do I want to retain in my business and move forward on? So I think there's some threshold questions that people need to do to say, hey, look, what am I really looking to accomplish here as part of that sale process? And then there's some more tactical of saying, hey, what do I need to do to prepare for a sale process? And a lot of that is going to be making sure that you have a fulsome management team in place. Oftentimes entrepreneurs are carrying a lot, they're the de facto CFO, the head of sales, the COO, and saying, hey, what part of my bench do I need to build out here? And what resources do I need to bring, whether that's outside firms like Matt to help get the finances in order, or internal hires that I need to bring to the table to kind of help prepare my business. And I think even as James touched into early, really just getting a sense of kind of what is my business in terms of a positioning standpoint, or the things I can do around the edges to increase my customer contracts and the duration of those, increase the certainty, reduce my customer concentration, things like that people can really focus on, that are going to be some first kind of threshold issues that people look at. But if you can get your house in order a little bit around your financials, that goes a long way. People really, being able to clearly answer and have access to numbers that are reliable and that people can quickly view, having the systems and the people to do that and deliver that is important. And then also just making sure that you have the right people in the room around you to support kind of the business. I think a lot of people think about, hey, I've got the right team for my business today, but any investor coming in is going to say, what do I need to take it for the next 5 years, for the next 10 years? And they're going to want to see, what do I need to invest in, whether it's IT systems, ERP, accounting, salespeople, to drive that next level of value. So it's kind of a mix of what I've got today and what do I need to get to the next 5 years.
Yeah, I think it's very important for owners to think as far in advance as possible about selling their company, because there are a lot of things that owners can do to not only make their company more presentable, but obviously more valuable. And when you think of the number of opportunities that investors like you guys look at, you have to decide which ones are worth spending the resources and the time on. And so the more buttoned up that a seller can be before they go to the market, the more eyes they'll get on it, and the more serious interest, and as well lead to higher valuations and better transactions. We have a question from Robert, who mentions that private equity, as James and we've talked about, does borrow money to do their transactions and helps them obtain the returns they're looking for. And oftentimes, family-owned and entrepreneurial businesses are a little averse to debt. And so as they start thinking about a transaction with private equity firm, and now there may be debt that puts on their company, and oftentimes get a little nervous about that. Matt, Dan, from a lending perspective, how can the bank help a seller realize the safe, and what are the things that you're looking for as you decide how much money to lend to a private equity firm as they're making an acquisition?
Yeah, that's a really good question, Garrett. We've had that happen. I've worked on transactions with a lot of the faces that are here today and the gentleman on the phone. And that sometimes has been the case where they feel like, hey, look, we've bootstrapped this business. We're really proud of the fact that I've never taken on debt and I've got to this point. And so the idea of leverage is a little bit scary. And so really that's a decision mutually between the private equity team and the business owner. Obviously, if there's a majority ownership being sold in the transaction, then the private equity probably has the final say, but they want it to be prudent. And I think one way we think about it with that seller is, look, we have to try really hard, especially as a commercial bank, to make sure we don't make mistakes. There's really not enough margin in our financing to really have even one mistake or one deal go bad. And so when we think about working through projections and modeling out what an appropriate amount of debt is, we love to sit down and just kind of take down the wall and say, what do underwriters care about? What do banks care about? And why does it matter? And what should you expect? And so it's sometimes a very new concept, but our job is aligned with, as I mentioned, the private equity team to say, we want to make sure it's appropriate and we're going to make sure that you can handle it. And we've got room in the covenants and there's cushion there. And we're all thinking about it kind of as a whole partnership rather than, you've just now walked into a scary place where you're going to have to cover this nut every quarter and make those principal payments.
And Chris, from your perspective as the investor, how do you think about borrowing money? Does your firm use leverage to do that? And what are some of the things that are important from you as you think about that?
Yeah, certainly. Well, I think one of the benefits ultimately from leverage is that it can increase the value of your business, right? Ultimately, it enhances returns for those who are investing, as well as, hopefully if you have continued equity in the business, it will enhance the returns of those. But it also adds a layer of discipline to the business, of operating discipline, where you have to meet certain goals in order to service the debt and to grow, right? And it brings another level of focus that I think can be helpful for an organization and professionalizing and building out an organization. But I think the point is that it's important to remember that, in no case, as Matt has outlined, is that you're going to want to get into a position where the business is over-levered. And I think that, all the partners at the table are going to be very thoughtful about how to do that, right? In a way that protects your investment and their investment as well. And so ultimately, I think that can be a good tool to kind of add discipline to an operating business and enhance returns for all parties.
We're getting to about 5 minutes before the hour, and so maybe we can just go around the panelists and maybe start with Matt Bartholomew. As you look at your current projects and your pipeline, if you pull out your crystal ball and you say, what is 2021 going to look like from your perspective in the M&A environment? How are you feeling about the coming year? And we'll just kind of go around maybe with Aubrey second, Matt Dent third, and then Chris finally.
Yeah, I appreciate that, Gary. I could keep this very brief. I think we work with quite a few different investment bankers and commercial bankers and have a pretty good pulse between our team here that's locally and then in California. And I feel like coming into 2021, we're probably 20-30% in the level of activity higher than pre-COVID, which is pretty incredible. And so between the financing possibilities with firms such as Matt's and the amount of dry powder that's out there with firms such as the family office Chris is at and Tower Arch where Aubrey's at and other private equity. I mean, there's just a lot of competitiveness that's out there chasing great assets. So I expect a very robust 2021.
Okay, great. Aubrey, your thoughts?
Yeah, I would echo Matt's sentiments. I think that 2021 is going to continue to see robust activity. I think we've from what we've seen come to market and speaking with investment banks and kind of what they're seeing in their pipelines and lenders and accountants, I think that there's going to be continued demand for M&A. There is a lot of dry powder out there. There's a lot of folks that are trying to put together or put out so much equity or debt to work every year that had to put that on pause a little bit last year. They're going to be playing catch up for this year. And there's still plenty of liquidity in the market. Interest rates are really low, and I think with between the combination of COVID starting to clear and seeing the light at the end of that tunnel, I think there'll just be a really robust demand from both entrepreneurs looking to sell and lock in taxes, as well as folks on the buy side like myself that are looking to find good investments. So it should be a very robust year.
Right. Thanks, Matt.
Yeah, Aubrey, you said it really well. We're seeing levels a lot higher than we've seen in years past. It's really started in September, August with some interest and demand, and then really flowing into the Q4 and Q1. It just has not slowed down. And as Aubrey mentioned, there's a clock attached to those funds that have been raised at unprecedented levels. So those are going to go to work. Our pipelines are full. We think about it. When you bring in opportunities from the private equity group, we're going to look at it a lot of different ways. We're going to be thoughtful around the cash flow, the partnership. We closed on an ABL yesterday, so there's a lot of ways to get things done to buy a company. And I think that capital for lenders across the board is readily available. Fortunately, this pandemic or this recession that we experienced in 2020 was not caused by the banks. And so we were part of the solution to a degree, and we're still healthy. And you see the whole market very active across the board. All types of lenders are being more aggressive than we even saw pre-pandemic. So I think it's a very strong outlook for 21.
And Chris, finally, your thoughts?
Yeah, I agree, with everything that's been said. And fortunately, we're in a similar position where our pipeline is as full as it's ever been. And it's difficult to even keep up with the opportunities that have been presented to us. And I think, in addition to the dry powder that's sitting on the balance sheet of investment firms and the timelines that they're working against, you also have record cash levels at corporate America. And so there's a lot of desire to invest that capital into projects that will grow those businesses. And so, our outlook for the economy and specifically the Mountain West region of the United States is very, very strong in 2021.
Well, I appreciate everyone's time. And I think, as business owners think about when is the appropriate time to sell their business, oftentimes that's focused on their own personal goals and internally what's happening within their company. And certainly those are very important details. But as you look at the macro environment and all of the external features that impact your ability to sell your company, I think we're in as strong as environment as we've been in. It still very much is a seller's market. And when you look at the pressures the current administration may have in increasing capital gains, tax rates potentially next year, it can make sense for an owner to decide to move forward maybe a little bit earlier than normally, just because of all these external features that they can't impact, but do impact their ability to sell. And so I think it's something that owners should think about. We really appreciate all of the panelists' time and their expertise, and look forward to speaking with you guys again. Thank you.
Thanks, Garrett. Thanks, James.
Thanks, everyone.